Previously on Luxurious Gazelle. So what's happened now is that everybody here has mutually funded this investment. And everybody makes money as the prices of all of these stocks go up. You can see through a combination of expense ratios and turnover fees and cash drag and front load that this is going to ultimately impact the amount of money that they have returned, because only a portion of what they started off with is actually going to work for them. Now, given that the couple doesn't really want to manage their finances, they just kind of want to do a set it and forget it kind of investment, they decide to go ahead and hire a broker. Screw him. We could go ahead and buy funds and invest without having to worry about all these other fees. What is an index fund? What is an index fund and why should you invest in one? An index fund is a type of mutual fund whose holdings match or track a particular market index. Okay, that's about as clear as mud. Let's try another one. What is an index fund from the Motley Crew? An index fund is a mutual fund, or ETF, that is designed to track a specific index of stocks, bonds, or other type of investment. For example, the S&P 500 index fund would invest in all 500 components of the index in order to replicate its performance. All right, that doesn't really help. Let's try one more. An index fund, also index tracker, is a mutual fund or exchange traded fund ETF designed to follow certain preset rules so that the fund can track a specified basket of underlying investments. What the f? So here's all of the investors, and I am going to take their money, just like before, and put it into the mutual fund, which I'm going to now go and buy individual stocks. But now the question is going to become, how do they know that I'm doing a good job as the mutual fund manager? If I say that it returns 8%, 9%, 11%, 12%, is that good? And if it is good, compared to what? So we need to find and establish a standard with which to measure this. So let's take a Ziploc bag, and in this bag, I'm going to put in some stocks, such as Facebook, do Microsoft, Best Buy, do Disney, Walmart, Qualcomm, and many more. Now this bag represents a collection of stocks. I'm going to draw a little graph on here. So what I have here is, on this one axis here is the value of the money, or there's just the value of the price, along an axis of time. So let's say I take the price or the value of all of these individual stocks and then take the average of that price. I'll then take that number and then plot it as a data point on this chart. So right there. Then the next day, the value of all this stuff goes up. The average of the prices goes up. There. Third day, again, the value and the average goes up. Then on the fourth day, the markets take a little bit of a hit, and all of these stocks and their average starts dipping quite a bit. The next day, it starts to plateau for a little bit. And I keep doing this day after day, month after month, until finally I get a moving average. And if I connect all the dots, something that looks a little like this. Since this line represents the average price of all of these stocks, if I have another grouping of stocks, say in a mutual fund, I can take that performance and measure it against this. This standard or benchmark is called an index. Now the red line on here represents my fund's return on the market. And as you can see, I have beaten the index pretty well. But as you can see in this scenario, I didn't do too well compared to the index. In fact, this is what happens with most active managers with mutual funds. Most of them cannot outperform their respective index in the long run. Now here's the issue. The investors all gave me their money so that I would beat the index and give them higher returns. And I obviously didn't do that. So not only did I not beat the market and do what I was paid to do, I lost their money, and on top of that, I charged them a fee to do that in the form of the expense ratio. That's like you hiring me to come clean your house, and then when I get there, not only do I not clean the house, I drop my pants and take a massive shit on your living room carpet and then charge you 30 bucks on top of that. Now, let's say I, as the mutual fund manager, ended up getting better than the index. I take this and I present it to the investors and say, hey everybody, check it out. Look how amazing I am. I beat the respective index. Now you can go ahead and feel confident in giving me more of your money. Now, while it's true, this line does represent the returns with the expense ratio incorporated, this return does not account for turnover, any kind of cash drag, or any brokerage fees that the investors might have had to pay. The actual return that the investors see at the end of the day, in other words, the actual amount of money that goes into their accounts at the end of the day, might look more something like this. So this blue line down here represents the returns the investors actually see. And this gap right here, that gap right there represents all those fees and transaction fees and brokerage fees and expense ratios that the investors all ended up paying. So here's the reality when it comes to actively managed mutual funds. The investors front up all of the money, take on all of the risk, yet end up with the least amount of return. I'm going to take a different approach as the mutual fund manager this time. I'm still going to take everybody's money that they've all agreed to put in to the fund. My strategy is not to try to pick particular individual stocks like Walmart or Qualcomm that are going to beat the index. Instead, my strategy is going to be to replicate the index. So what that means is I'm going to take the investor's money and I'm going to look at the index and just buy whatever's in here. So the index contains shares of Apple, Google, Enterprise, Target, Michelin tires, and so on. The stocks that I put into this mutual fund are going to be the same stocks as that are in the index. It's still a mutual fund because I'm still using money that was pooled by all the investors in order to buy all these shares. It's just instead of me actually trying to beat the index, now I'm just replicating it. And when I try replicating it, this mutual fund now becomes an index fund. It's simpler, more elegant, but still serves the same function as a regular mutual fund. And the index fund is going to follow the index. So if the index goes up over time, the index fund is going to yield positive returns. If the index ends up going down over time, then the index fund is also going to yield negative returns. Now, since I, as the fund manager, am just copying whatever's in the index, I'm not doing any work on my own. It's kind of like copying off of the smart kids' test answers. So my work involvement, and therefore the expense ratio, which is associated with my work, is much, much lower compared to the active managed mutual fund. Also, indexes don't generally have a whole lot of stocks that are being moved around. They're pretty much set in stone with the way that they are. Maybe the proportions change a little bit, but that's about it. So that means I'm not going to be doing a bunch of, stock for stock trading, again, trying to beat the market. And because of that, the turnover percentage is much lower, and lower turnover means lower fees for the investors. Additionally, because the turnover is so low, I don't need to have a whole lot of, cash reserves on the side to take advantage of any opportunities because the index is just not going to be changing over time. So that means I don't have to have a whole lot of cash set aside, and that cash drag is not going to be affecting the overall investor's returns. which means more money from the investors is actually invested and making money for them. And finally, index funds can be bought directly from the brokerage that makes them. So places like Vanguard, Fidelity, and Charles Schwab all have their own versions of an index fund, which means that this guy can take a hike. So this index fund right here is a very passive fund. There's not much work required on my end to manage this. So if you were to kind of think of it as like the house cleaning example that I gave earlier, whereas the mutual fund, the active managed mutual fund, was kind of like a house cleaner coming in to clean your house, and they may or may not do the job, and you may end up with more than what you paid for. The index fund is more like a Roomba, where you just kind of monitor it and make sure that it gets a good charge and clean it out every now and then, but it's pretty much going to go out and do its thing by itself with minimal effort on your part. Now, back to indexes for just a second. Let's say we take the top 500 companies that are traded on the New York Stock Exchange and put them all in a bag and calculate what that average is over time. Well, that is called the S&P 500 index. If we were to take the top 30 biggest companies in the New York Stock Exchange, the big mammoth dinosaurs of the dinosaurs, okay, again, this would also be probably like Disney and Microsoft and a lot of the other ones, but just the top 30, and you took the average of all of those, now you have the Dow Jones Industrial Average. And finally, if you take 3,000 tech companies and emerging companies with new markets and stuck them all together, you get what's called the NASDAQ. The S&P 500, Dow Jones, and NASDAQ are three of the major indices that basically track the entire United States economy and the stock market. And there are index funds that are out there designed to track all of them. So index funds really help bring in more money for their investor by specifically lowering all of the costs associated with an active managed fund. That's why these are usually known as passively managed funds. Now, the thing is, as great as index funds are, the question now becomes, how do you compare the two? And what should you look for when investing into an index fund? So those are some things I'll go over in next week's video. So until then, have a great one. I will see you next time. So what I've made here is a standard or a benchmark, and it represents the average price of these stocks as it moves. So what I've made is a standard or a benchmark, and it represents the average of all of these stocks as they change and their prices change throughout the day or throughout, no. So what I've made here is over time of a bunch of other stocks. Since this line represents the average of all of these funds. Now, what? The investor's money, and I'm going to do that again. That this guy can take a hike. And he wanted to make his point on the way out. If we were to take the top 30 companies of the biggest company, we were to take the top 30 companies of the biggest, all right,